So picture this. A major bank just posted its best quarter ever. Sounds like great news for the economy, right? But if you dig a little deeper into their report, you see they're also getting ready for a potential storm. Today, we're diving into the latest numbers from the Royal Bank of Canada to figure out what this paradox really tells us about what's coming.
All right, let's just jump right in with the headline number. And wow, it is a big one. $5.4 billion. That's the net income RBC brought in for a single quarter. And let's be super clear here. This isn't just a good quarter. We're talking about the most profitable quarter in the bank's entire history, ever.
And this wasn't just some small increase either. We're talking about a massive 21% jump from the same time last year. Now, for a financial giant like RBC, growing by over a fifth in just a year, well, that's like an ocean liner suddenly taking off like a speedboat. It's a truly massive surge in their profits. So, how'd they do it? Well, the bank CEO points to something he calls a diversified business model. Now, I know that sounds like a bit of corporate jargon, but trust me, in this story, it's actually the key to everything. So let's pull back the curtain and see which parts of the bank were really firing on all cylinders. All right, so where did all this cash actually come from? Was it just one lucky break, or is there something bigger happening under the hood?
And this is where it gets really interesting. This wasn't a one-trick pony. The growth was spread right across the entire bank. You can see the two biggest slices here are personal banking, mortgages, daily accounts, and capital markets, which is their high finance division. They were the heavy hitters, for sure. But look closer. Basically, every single part of the bank chipped in. That's the diversified model the CEO was talking about right there in action. Okay, let's break it down. A huge chunk of this profit came from their capital markets division. You can think of this as the part of the bank that deals with the really big league stuff, helping huge companies merge, advising governments, and business was booming. They were closing more big deals, and their global trading desks were making some really smart, profitable moves. Both were just incredibly lucrative. But it wasn't just Wall Street, it was Main Street too. At the exact same time, their bread and butter business was on fire. We're talking about the everyday banking for regular people and small businesses. Their income here climbed for a very simple reason. More people were borrowing money, and more people were depositing money. It's the absolute core engine of any bank, and yeah, it was running hot. And then there's the third engine, wealth management. This is where the bank manages money for its wealthiest clients. And they saw a big boost here for a couple of reasons. First, the stock market was doing pretty well, which automatically grows their clients' portfolios. And second, they were just really successful at attracting new clients and new money. Both of those things grow the total pot of money they're managing, and of course, the bank gets a piece of that as a fee. Okay, so everything looks fantastic, right? Record profits, growth everywhere. But this is where the story takes a turn. Because hidden behind all these incredible numbers, the report is also flashing some serious warning signs. It's kind of like they're saying, yeah, today is sunny, but we're definitely keeping an eye on those storm clouds on the horizon.
So what are these storm clouds they're worried about? Well, the report actually gets pretty specific, and it gives us this rare glimpse into what keeps the top execs at a global bank up at night. And you can see, these aren't small worries. They're all on a global scale. Think about it. Changes in U.S. trade policy and tariffs, that can totally disrupt the supply chains for their biggest corporate clients. Central banks in different countries changing interest rates, that affects the profitability of every single loan they make. And of course, geopolitical conflicts can rattle the markets, which hits their trading and wealth management businesses hard. So for them, these aren't just news headlines, they're direct threats to their bottom line. There's one really clear way to see this caution in the actual numbers. It's a little bit of bank speak, but it's super important. It's a line item called Provision for Credit Losses, or PCL for short. The easiest way to think about it is like a rainy day fund. It's the money the bank sets aside today just in case some of its loans go bad in the future. And here's the kicker. Their actions are speaking way louder than words. That rainy day fund, it's grown by more than $200 million compared to last year. Let that sink in. The bank is actively taking cash from its record profits and socking it away, specifically because it thinks there's a higher chance that people and businesses might struggle to pay back their loans soon. Honestly, it is the single clearest warning sign in this entire report. Okay, so let's zoom out. We've got these two totally different stories playing out at the same time. On one hand, you have these incredible record-breaking profits, and on the other,
you have the bank preparing for a potential downturn. So what does it all mean when you put it together?
Well, it really boils down to three key things. First, there's no doubt about it, RBC is in an incredibly powerful financial position. Second, this success isn't a fluke. It's coming from all parts of their business working together. But third, and this is really the most important takeaway, they're not just popping champagne. They are actively using this period of strengths to build a bigger financial fortress, bracing themselves for whatever economic turbulence might be coming.
And that really leaves us with one big question to think about, doesn't it? When one of the world's biggest and most successful banks is having its best year ever, but is still quietly preparing for rough seas ahead, what does that signal to the rest of us?
Welcome to the debate. Today, we are focusing our analysis on the Royal Bank of Canada's third quarter 2025 financial results. This report presents, well, a classic tension. The bank achieved record net income, yet it simultaneously delivered significant spikes in key credit risk metrics and acknowledged a growing list of external threats.
Indeed, when major financial institutions report a headline figure like, record net income, the narrative often becomes overwhelmingly positive. But for experts, the real conversation needs to look past the top-line euphoria and scrutinize the metrics that reveal vulnerability, especially when global credit cycles appear to be maturing.
Exactly. So our central question today is framed by that tension. Does RBC's record Q 2025 results primarily confirm the fundamental strength and strategic success of its diversified business model? Or are these headline figures significantly undermined by accelerating credit quality deterioration and persistent external geopolitical and regulatory risks? I will be arguing that the broad-based performance affirms the bank's core strength, suggesting the success is structural and, sustainable.
And I will be countering that the alarming rise in credit risk metrics and unresolved global uncertainties necessitate a highly cautious interpretation of this quarterly success. We must value vigilance over celebration, focusing on the material realization of risk that these impressive earnings are, frankly, currently masking.
Okay, let's begin with the evidence supporting the bank's inherent strategic strength. RBC achieved record net income of $5.4 billion for the quarter, reflecting a robust increase of 21% year over year. But the most important figure, I think, the real indicator of operational efficiency, is the pre-provision pre-tax earnings, or PPE, which reached a record $7.8 billion. Now, this is a substantial 29% increase from the prior year. This tells us the core operational engine is firing exceptionally well, demonstrating strong operating leverage before we even apply the credit impacts you're so concerned about.
But those pre-provision earnings, while robust, serve primarily as a necessary buffer against risks that are not merely theoretical. They are materializing right across the balance sheet.
Well, I would argue the strength is confirmed by the diversification of that growth. Net interest income was up 14% year over year, driven primarily by strong average volume growth. That's 3% in loans, 2% in deposits, and higher spreads in personal banking. That NII growth confirms the reliable bedrock engine of Canadian commercial banking is firing perfectly. Furthermore, wealth management saw investment management and custodial fees increase 11% year over year, largely due to market appreciation and, importantly, net sales. This suggests sticky, long-term asset accumulation, not just, transient trading luck. Finally, the capital position remains rock solid with the Common Equity Tier 1 ratio, the CET1 ratio, at 13.2%, stable quarter over quarter and well above regulatory requirements.
That stability is certainly a comfort in isolation, sure, but you cannot discuss diversification without acknowledging the accelerating uniform risk across those key segments. The record earnings fundamentally mask a concerning increase in credit exposure. Total provision for credit losses, PCL, increased by $222 million from a year ago. What worries me most is the composition of that risk. PCL on impaired loans saw a dramatic 47% increase year over year. That is the ultimate metric of credit deterioration, isn't it? And it was driven by higher provisions across capital markets, commercial banking, and personal banking.
Okay,
but the total PCL number was down quarter over quarter.
We'll get to that, but focusing on impaired PCL, that is the realization of risk, and that trend is moving unequivocally in the wrong direction. We also see specific gross impaired loan, or GIL, increases that demand scrutiny. In personal banking, the GIL increased 6% quarter over quarter, driven specifically by higher impaired loans in Canadian residential mortgages. This points directly to strain in a critical domestic portfolio, not some faraway emerging market risk, but right here at home. Furthermore, the report explicitly outlines significant global uncertainties, including the impacts from implemented and potential additional trade measures, substantial fiscal deficits, and ongoing geopolitical conflicts, which pose serious external threats the bank cannot fully control.
Okay, let's focus immediately on that interpretation of credit risk, because that is where our disagreement is most substantive. I grant you that the 47% year-over-year comparison on impaired loans is steep and warrants careful monitoring. No CFO wants to see that headline. However, the operational reality is that the overall PCL picture is currently favorable quarter over quarter, decreasing $543 million or 38% from the prior quarter.
And why was that PCL lower exactly? That shift is the key to understanding the risk sensitivity, not stability.
Well, it was largely due to lower performing loan provisions, which swung to a release of $28 million compared to a significant $568 million provision last quarter. Now, this swing reflects favorable changes to the macroeconomic forecast scenarios used by the bank. Given the massive buffer provided by the record pre-provision earnings of $7.8 billion, the impairment increases, while material, are well within management's capacity to absorb. The PCL on loans ratio decreased 23 basis points quarter over quarter. That speaks to proactive management and a stabilizing outlook reflected in the internal models.
I see why you think that, but let me give you a different perspective. That large quarter-over-quarter fluctuation in performing loan PCL doesn't indicate stability. It highlights extreme sensitivity. The massive $568 million provision last quarter reflected unfavorable scenario weighting driven by the potential impacts of trade disruptions and tariffs. This quarter, the provision was largely released. That swing demonstrates how easily the bank's provisioning models are buffeted by external political and economic shifts, risks that are inherently non-structural and frankly unpredictable. We must focus on the trend of impaired loans, which are a concrete, realized form of risk, not just a prediction. The impaired PCL trend is unequivocally rising across capital markets, personal, and commercial segments. Capital markets PCL on impaired loans, for instance, increased $138 million year over year due to, high-profile account deterioration.
While capital markets PCL on impaired loans increased, yes, we must pivot to the engine that offsets that: the sustainability and diversity of the underlying revenue growth. Personal banking revenue grew 13% year over year, anchored by fundamental volume growth in Canada. This reinforces the core, most reliable banking franchise. Furthermore, the wealth management segment is also robust, with fee revenue gains tied to sustained market appreciation in net sales, suggesting clients are sticking with the bank, which helps reduce transactional volatility.
That's a sophisticated defense, emphasizing the sticky core segments. However, I think you're missing the forest for the trees when it comes to the marginal driver of this record performance. The capital markets segment, which saw global markets revenue jump 37% year over year, largely due to higher fixed income trading revenue, is inherently cyclical and vulnerable. The document itself notes that fee pool growth was muted in early 2025 before the Q3 recovery. High revenue derived from pure trading activities is non-structural, sensitive to market conditions, and historically prone to sharp contractions when macroeconomic uncertainty forces clients to pause activity. If that 37% trading boost vanishes, your 29% PPE growth looks very different, doesn't it?
That's an interesting point, though I would frame it differently. The strength isn't purely reliant on transient trading surges. Underwriting and advisory fees were up 26% year over year, reflecting strong client activity in debt, equity origination, and M&A. This is evidence of strategic market share gains and deep client relationships, not fleeting trading momentum. We are positioned to capture major corporate financing deals. The entire point of a diversified model is mitigation. Weakness in one area, for instance, lower municipal banking activity in capital markets this quarter, is readily offset by strength in global fixed income or the robust fee income generated in wealth management. The engine has multiple cylinders working simultaneously.
Okay, let's move beyond the cyclical nature of revenue and look at the structural costs introduced by the external environment. We see tangible regulatory impacts already costing the bank. I'm referring specifically to the adjusted effective income tax rate, which increased 430 basis points year over year, rising to 21.2%. This is a direct, higher cost of doing business, primarily due to the implementation of the Pillar 2 global minimum tax legislation, which became effective last November. This is not a forecast or a volatile swing. This is a realized, structural headwind that permanently increases the operational expense of conducting business internationally.
I acknowledge the Pillar 2 tax impact, which did increase the rate by approximately 1.3% for the quarter, yes. However, management successfully navigated other significant regulatory hurdles, maintaining capital ratios stable and well above requirements, which is a key measure of risk management success. For instance, the indefinite delay in the increase of the capital floor factor, maintained at 67.5% of risk-weighted assets by OSFI, provides significant regulatory stability and relieves capital pressure that was anticipated. The CEO's stated focus on operational discipline and risk and expense management is specifically designed to mitigate these known external uncertainties, allowing the bank to maintain its 13.2% CET1 ratio, despite factors like RWA growth and share repurchases. They are absorbing the hits.
That's a sophisticated acknowledgement of regulatory management, yes, but the core issue is diminished financial flexibility. While the CET1 ratio is strong, we cannot ignore the leverage ratio exposure, which stands high at 4.5%. That ratio measures the bank's total leverage exposure against its Tier 1 capital. A high ratio combined with the new, non-negotiable structural tax cost imposed by Pillar 2 means the bank faces a significantly increased, tangible regulatory burden moving forward. You have to pay the tax, and you have to manage the leverage. Couple this with the explicit documentation of elevated geopolitical risks, trade tensions, and substantial fiscal deficits, and the path forward suggests increasing constraints, not smooth sailing.
Ultimately, the Q3 2025 results are a clear testament to the bank's successful strategic execution. We have seen record operational performance demonstrated by that massive $7.8 billion in pre-provision earnings. We have robust capital adequacy and, critically, resilient, diversified revenue streams in core segments like personal banking and wealth management that can withstand normal market volatility. The business engine is firing on all cylinders, allowing the bank to effectively absorb known credit risks without operational strain.
I'm sorry, but I just don't buy that the bank is merely absorbing known risks. They are absorbing realized deterioration at an accelerating pace. While the top-line results are record-setting, the material 47% increase in PCL on impaired loans, which shows concrete strain in Canadian residential mortgages, and the continued high leverage exposure ratio demand extreme vigilance. The volatility in performing loan provisioning, swinging hundreds of millions based on scenario weighting, underscores the fragility of the outlook. When combined with the tangible, structural cost of Pillar 2 tax rules and the looming specter of codified geopolitical risks, the path ahead requires careful vigilance against persistent external threats.
Well, the source material provides compelling evidence for both sides, doesn't it? Both the exceptional immediate performance and the necessity of closely monitoring evolving credit and macroeconomic risks. The divergence between these two views, the celebratory earnings versus the cautionary credit metrics, is exactly what makes this material so substantive and valuable for deeper scrutiny.